Welcome to the 5 C's of Credit, the second module in this chapter. In this module, we'll go into a little more detail on the 5 buckets of information that lenders use to make a decision. Lenders evaluate loan applications based on their credit box, and that credit box includes the 5 C's. It's a system used by lenders to gauge creditworthiness of potential borrowers. The system weighs 5 characteristics of the borrower and conditions of the loan, attempting to estimate the chance of default and consequently the risk of a financial loss to the lender. So there you have a nice graphic of the 5 C's of credit. You can use that with your borrowers if it's helpful. And we're going to start with capacity, cash capacity. So when we're talking about cash capacity, we're talking about debt service coverage, the ability of a borrower to have enough cash in their situation to make the monthly loan payment. So the applicant's available cash after expenses, is that greater than the monthly loan payment, at least by a little? Lenders that I've worked with, the CDFI lenders I've worked with, they're usually looking for about 125% coverage. And that would mean that if the monthly loan payment's $100, they'd like to see cash capacity of about $125 per month, and that way there's a little cushion for the loan. And in future modules, we'll give you more help on calculating that. There's many ways lenders calculate that, and we're going to present 2 here, so it won't be exhaustive, but it will start to get you familiar with how that works, and then you can refine it as you learn more about the lenders in your area. So in determining cash capacity, you may see a difference in your area between the mission-based lenders and the conventional or traditional lenders. Conventional lenders are more likely to use historic performance, the past 2 or 3 years of historic profitability performance, to determine whether there's capacity for the loan that they're analyzing. And they like to rely on financial statements, profit and loss and balance sheets, these kind of more sophisticated documents that established business owners can produce. And they're looking for the business to pay back the loan. If we hop over to what our mission-based lenders are willing to do, they're willing often to look at more recent history instead of going back 2 or 3 years to see capacity. They might just look at the last 6 months. They might be willing to look at bank statements instead of financial statements. Bank statements are much easier for our client base to produce than the formal financial statements. And they're more likely to consider personal sources of repayment for young and startup businesses. Many of the clients we serve, their business isn't at a stage that can qualify for the cash all by itself. So there are lenders out there, and I've seen it both on the more conventional side and on the mission-based side, that use this global cash analysis to determine cash capacity. And what that means is, you can see over there in the graphic, they take all sources of personal income and all sources of business income and add them together, subtract out personal expenses and business expenses, and see what's left over in order to determine the cash capacity. Because there's potentially other sources of repayment that some lenders will look at, such as the day job of the owner. So maybe the owner still has a regular employment job while they start the business or run the business. Perhaps their spouse has income that can contribute to the cash capacity analysis. Maybe there's other kinds of payments coming into the household that also contribute to the cash situation. So that's our quick intro to cash capacity question. Now our next C is character, and I want to present this in 2 parts. So part 1 is looking at the client's credit history. So for most people these days, character means looking at the credit report and the credit history, which we've talked about some and we will talk about more in future modules. And it's most likely going to be the personal or consumer credit report that is pulled. A business has to be very well established to have a business credit report. So when you're working with clients, always pull their personal credit report and take a look at it. Now, lenders have lots of ways of using the credit report. So there isn't one approach, but here are some ways that they do use it. They'll look at this thing called the FICO score. That's the most kind of common credit score out there. It's the one that I know most CDFIs use. They'll look at things like slow pays and collections, and we'll talk about that more. They'll look at the amount of credit used or available. That means like how leveraged already is the borrower. Do they have lots of loans showing up with a lot of, you add up all the monthly payments, it looks pretty extensive? Or is their current, loan situation pretty lean and it looks like there's room for additional debt to be taken on? Credit history is one of the most important elements of qualifying for a loan, and it's also one of the biggest barriers the clients that we serve face in terms of qualifying. Please watch the modules 7 and 12 for more detailed information about credit reports, their use in underwriting, and how your clients might be able to improve credit. I also want to strongly recommend you look at this organization called Credit Builders Alliance. It's a nonprofit organization that builds the capacity of their nonprofit members to help clients build credit and enter the financial mainstream. They have a wealth of information and training and services that you can participate in. Some of our mission-based lenders will look at this question of character more broadly around reputation. Does the borrower show a history of making all their rent payments on time, their utility payments on time, their insurance premiums, or is their banking history show very few bounced checks? They'll broaden their scope beyond the credit report. So I think that's important to understand whether one of the lenders in your area will take that broader view. They also might look at things like, has the client completed a business planning course and have they written a business plan? This can matter to certain lenders that there's some training that's happened for the business owner. Other things like, is the customer reliable? If you make appointments and ask them to complete things, do they do it on time? Do they show up? Do they show stick-to-itiveness? This is like the other side of that character question. Our third C is collateral, which are assets pledged to guarantee the loan. And a lender places a lien on assets so they have a legal right, if they need to, in situations of default, to go and collect the collateral and liquidate it or sell it. So conventional lenders like secure assets such as equipment, vehicles, real estate, things like that. And the asset value often for conventional lenders has to be equal to the loan amount. Mission-based lenders might just take a blanket, they call a UCC filing, on all business assets. I worked with a CDFI once that said, yeah, we've got $75,000 loans in our portfolio backed by a $5,000 car. And they felt comfortable doing that because they knew people really want their cars desperately and they don't want to lose them. So they actually thought that was a pretty secure way to secure their loans. Some lenders also might require a personal guarantee, which is a legal promise to repay credit issued to a business from personal sources, which means that if the business goes belly up, that the lender could come and perhaps take some of your personal assets or require you to personally pay back the loan out of other sources of income. So our next C is capital. And lenders want to see that business owners have invested in their own business, that they have some skin in the game. So there's several ways this could look. One is that they just have cash to invest in the project, especially as projects get bigger, like a real estate project, for example. They'll want to see that the owner has a down payment to contribute to the project. There are other ways this could look, though, that the owner has made previous investments in the business. They've grandfathered in some assets from their personal side and committed them to the business, or that they've reinvested profits from previous years. Now, reinvested profits show up on the balance sheet as retained earnings. Again, we've talked about how many of the people we serve don't have that document or don't keep it accurately developed, so they won't be able to show that. But for more established businesses that have a balance sheet, retained earnings can be a sign that the business has been profitable in the past and has reinvested those profits in the business. So we're on our final C, conditions, and these are factors that affect repayment. And this can vary really broadly by lender. It's hard to know what conditions matter to a lender. And some conditions are within a borrower's control and some are not. So what might some of these conditions be? Certainly the overall region and national economic conditions. Are we in a recession? Are we not? Out of a borrower's control, but that's going to impact to some extent what a lender decides to say yes and no to. What is the loan structure? And again, remember the lender is trying to match what they see in the application to the products and conditions they have within their organization. Is the industry high or low risk? Do they already have a concentration of that industry in their portfolio, or do they have some room to take on another loan in that industry? Organizations also risk rate their loans, and they might find themselves too highly concentrated in high-risk loans, so they have to turn down your client because they're looking for stronger deals. Again, these are the types of conditions that a borrower doesn't have any control over. Again, the clarity of the application matters because I think you're making a case that this is a strong business owner in a strong market. In a strong economy, everything about it is strong. The more you can make that case, the better. And also what the business trends are. Can you show historically that there's a growth in sales and or profits? And remember, each lender will have a different list of conditions. And the best you can do is try to get to know your lenders and see which conditions matter most to them and see if you can help position your borrowers to fit this C. So that completes our overview on the 5 C's of credit. And I'll see you in the next module that focuses solely on credit. It'll give you a tremendous amount of information on how to analyze this really critical piece of the application process.